Hello and welcome to the Trading Zone. I'm Joe Tigay. Happy Monday to all of you traders out there. It's another day in paradise, right? We got gold skyrocketing. I'm going to be trading that later today. Just absolute chaos in the market, though, as usual. We got stocks down, being led down by the semiconductors, having a huge downway. Technology, of course. Not too far behind. Nasdaq looking very weak. Some of the so-called value plays looking slightly less weak, but still having a bad day to say the least. As this is going to be a very big week, and we're going to get into all of the reasons why. But I just want to say thank you all for joining. You got any questions? Want to talk any market with me? Let's talk. You want me to look at some charts? Be happy to do so. Make sure to say hi, and we're gonna do we're gonna have some fun today. We're gonna get into a lot of the reasons why the market's moving the way that it is and the volatility that the market is being seen. So really happy to do so. We'll be joined in a little bit by Brian Stutland as we move along here, but absolutely another day of volatility, no question about it. We're seeing the market experience some volatility, and it's really interesting to see where exactly it's showing up in the market. So let's take a look here at the market. There we go, the market and its volatility. This is a Trading Zone. I'm Joe Tigay, portfolio manager at Equity Armor Investments, and let's look at the market here. So we got some big news this week, very much so, absolutely. I'm going to get into all that as we go on here. Really big news, really important week for, it's not so much like the data. The data is important this week, but kind of just like the unknowns are just really big this week. And it just feels like there's a lot of things happening, but they're kind of all happening at the same time. And it kind of seems like they're part of the same puzzle. So yes, we got the tariff war coming this week. Very crucially, the IMF is going to be in Washington this week. So there's going to be a lot of side discussions while a lot of the economic leaders are here. And while this is happening, the U.S. is trying to do some deals with Europe, trying to do some deals with other Asian partners, trying to corner China right now. And while that's happening, China is saying, hey, don't do that. Don't side with the U.S. Side with us. We'll give you a better deal. Really interesting to see. It's kind of escalating here in that U.S. versus China, almost seemingly like reminiscent of the Cold War era, where we had a block of communist countries trading against the West. This is kind of seemingly it's China and its block versus the U.S. is what it's shaping out to be. Obviously, that was much more drastic. We need to remember there was literally zero trade going on between the U.S. and communist countries back in the 70s, for instance. But this is just like a trade war. We're going to reduce our trade. We're going to put penalties on trade. That's really what is happening when that comes on that front. But when it comes to the rest of the market, I think the big news today is just the absolute plummeting of the U.S. dollar. And this is what it's all about. Trump is saying, hey, Powell, lower interest rates. That's really losing a lot of credibility in the dollar. People do not want to own an asset which is going to be depreciated. And people are just saying, hey, I want out. It's been happening for some time. And while that's happening, of course, we're seeing gold skyrocket. But I think much of it is just the dollar falling. And of course, we know the dollar is priced in gold. It takes more dollars to buy the same amount of gold when the dollar falls so quickly. So we're seeing a rapid decline in the dollar index. And of course, obviously, not surprising, a rapid rise in gold as that happens. So really interesting to see that play out. This is the big economic events this week. We got lots of Fed speak. Shouldn't be discounted with the Beige Book coming on Wednesday. But I'm kind of looking forward to the PMI the most. Maybe that's just kind of a lead on how the economy is holding up here. We got a couple of factors weighing on the economy. Of course, there's the federal job cuts. maybe those are going to start to filter through, have an effect. And obviously, a bigger impact is the tariff war continuing on. So is that starting to show some damage to the economy? We might get a clue on the PMI, not so much on the beige book. That might have been like backwards looking. I think the consumer sentiment, I'm not really thinking that's going to, we're going to learn much from that on the consumer sentiment final. It's been kind of like a really noisy signal. It just seems like really knee jerky. So I'm not as concerned about the consumer sentiment, although I wouldn't be surprised if it were particularly weak. Anyways, let's just take a little bit of a deeper dive into these stories, because it really is, there really is a lot to look at here when it comes to the potential news headlines. And you can't really predict these headlines because they're so unusual, they're so unknown. But here's what's going on this week, and here's what could happen. And I think there's a lot of potential good news for the market. I think the status quo would be just a continuation of bad news if we didn't get a surprise good news here. So so we got the IMF coming. I think trade deals announced with Canada would be really big. Trade deals announced with Japan, really big. Anything with England, very big. Europe, of course, Germany, France, that would be very, very big, and kind of just solidifying that block, just kind of still solidifying this like stance on, hey, China is dumping goods on us. China is not being a fair trade partner. China is devaluing its currency, stealing our products with intellectual property theft. So if we can get on board with our partners there, solidify that deal, I think the market would view that as a major positive. Again, nothing has happened yet. We'll have to wait and see if that does, if any trade deals do come to fruition. The PMI to be on the 23rd, really big. Manufacturing services, obviously, that could tell us a sign the economy is already slowing down with that. Also, I haven't even mentioned this yet. Tax bill developments. There was a preliminary budget pass through. They got through both houses, but we got to really hammer this down and get through the fine deal. There's no significant deal has been signed yet, but they are working on it. Maybe this isn't imminent, but I think this could be a signal that an imminent deal or an announcement of a deal could be a catalyst to drive stocks higher. Obviously, I think market is looking for tax cuts, corporate-friendly tax cuts. That would be really big for stocks, obviously. Market is looking for deregulation. Certain sectors could benefit from there. I'm actually thinking maybe even the banks would benefit very big from some deregulation. That almost could fix a couple problems. We know about the liquidity issues with the reverse repo. If banks can get into there and be the market maker rather than the hedge funds, that could add a ton of liquidity to the system. So we'll see. We'll see if that takes off. Now, beyond tariffs, there's hot wars going on still. And, the good news on those hot wars is we are working on trying to stop them. I'm not necessarily holding my breath that a deal will come through this week, but certainly it could. It would be a very positive sign for me that we are working closer to that the market could go higher if there were a trade deal. We've heard some rumors about some potential offers out there. So again, this is something out there. It's possible, not discounting the possibility. Certainly would be bullish for the market if this did happen. And also, it's almost the Iran nuclear talks. This is something kind of just people aren't thinking about going on behind the scenes. This could be good news, could be very, very bad news if it escalates the wrong way. So just another thing I have on my radar. Don't want to see more wars around the world, but this is just another potential, crisis point. Maybe this Iran deal is part of the package to end the Gaza war. Again, we're just going to be watching it as it play out. Can't really predict it. Obviously, that's kind of the point. But short of these deals, it just seems like the market is on the path of least resistance, and that is lower. We're in a bear market. We got a declining 50-day moving average. We've crossed through the 200-day moving average. So this absolutely is a negative sentiment in the market. And, I'd love to see it stop. But, boy, we got some volatility out there, and it is not stopping until the market stops. Obviously, I think there's just too much uncertainty. It's not going anywhere. Let's take a look at the SKU index. This is the measurement of the difference between the 25 delta put and the 25 delta call 30 days out in the S&P 500. This is something I track, kind of a leading indicator to volatility. Now, we know volatility spiked up to 60 in the VIX and came down a long way, but we've hit a floor here, kind of where we expected, above previous levels of resistance, this area here. So certainly not too big of a shock to see volatility stabilizing up here. So we got a VIX, 34, 35. That's high levels of VIX. Okay, we're expecting over 2% move in the market every single day for the next 30 days when you see levels of VIX that high. And yeah, that is super, super high, of course. And we're early in the cycle. So this is the VIX futures curve here. This is the front month here, so this will be expiring in the middle of May. So we're early in the cycle here. We expired last week for April, and you're seeing this big gap here between where the front month is and where the cash is. So we'll expect that to narrow over time, but certainly the futures traders at least are saying, hey, volatility is really hot right now. By the time expiration comes around, we'll see this spot come back down in line where the futures are. On the flip side, though, if they're wrong, if volatility continues to trend higher, there's a lot of room to the upside in these futures. So absolutely, the knowledge and understanding that, and understanding how these futures work, is crucial to its trading. So again, happy to answer any questions on this, talk about this. As you know, I'm a former VIX options market maker, so I've seen this plenty of times in the past, and this is just another time where we're seeing it. People are anticipating volatility to come back down. Oftentimes that's what happens, but it's extremely volatile, extremely risky to be holding these futures unless you really, really have a handle on what's happening underneath behind the scenes. This is kind of the chart that won't give up. These channels, I've been following these for a long time. It was the first sign of the slowdown where we could not get back into this channel here last year, and absolutely we cratered through here, and then just amazingly we found support close to the bottom under this channel, and now we just cannot get above this high in this channel. This is what I was talking about last week. If you're following me last week, the recession path, if the U.S. economy is going into recession, which I think what we were talking about a few minutes ago, and those potential things that could be bullish for the market, bullish for the economy, if something does not happen, we will be on the recession path. So the recessionary path is the S&P 500 chart making this very big head and shoulders top formation right here, which unfortunately is what we're looking at right now. This is going to put us down 1,500 points here. It's put us down here to 3,500. Right about in here, if that's price target, if that's what would come to fruition. So we don't want to see that to happen, but that's what you have to follow the charts and just say, hey, this is what it is. As a trader, what you want to have happen, what is going to happen, it's miles apart. Nobody wants to see a recession, but just recognizing these charts, the charts are telling us one thing. We need to listen to them, be following these headlines. Headlines can change everything on a dime. The market is very headline sensitive right now. But I just warn, and I'm just worried, the longer this drags out, the more inevitable this pattern happens. So very concerned about that potential. Here's just another look at it. It's just a 1-year chart, basically the same here. This is in the futures chart, so it's absolutely very similar, even more of today's action here down here. So of course, head and shoulder top. We don't want to see a new low here. That'll be kind of confirming this head and shoulders. Now sometimes we get a flush out. There's some stop orders here, and then the market takes it out, and then it becomes a failed move. We're worried of that, of course. But if we get confirmed down here, stay below here, I think it's very, very bad news for the economy and the market as a whole. Taking a look at the semiconductor index, more pain, not good. You want to see this index leading the way. Instead, it's leading the way to the downside. The lows are just much lower, and we are closer to making these new lows here. So was watching this very closely. This is a sign of a growing economy when it's going up. It's a sign of a shrinking economy when it's going down. So very important for me to see that going higher. Now that said, the banks have been looking a little bit better. I think that's kind of like maybe the one of the things I can look at and say, hey, this doesn't look like a financial crisis right now. It doesn't look like, we're seeing bankruptcies or margin risk or that sort of thing. So the banks have kind of held it together here. And I really, maybe we can kind of lean on the banks, lean on some of the value names to get through this without too much damage when it comes to a recession. So just kind of watching that closely here. Taking a look at Bitcoin here. Finally actually getting an uptick here. It's been kind of a risk off trade. Gold has just absolutely stomped it when it comes to the inflation trade as of late. People are saying Bitcoin's inflation protection. Gold has said, hey, I am him. I am the inflation protector. Bitcoin's just kind of been more of like a pure risk on, risk off play. Nice to see it to get a little bit of a leg higher today, but again, I'm really looking at gold now. Back to just one more chart here when it comes to the recession slash risk slash semiconductors. Taking a look at Nvidia versus Cisco, the 2000 .com bubble. You had the hardware provider Cisco just kind of building out the broadband infrastructure, all that, and there was lots of hype about how big that's going to be. Similar story to Nvidia, building out the infrastructure for AI, the data center infrastructure. People are bringing this chart up. It's hard to ignore. I think the risk is there. If we hit a recession, it's going to be really hard for Nvidia. But I just kind of think that in 2000 versus where we are now, the .com bubble was in a different stage than where the AI bubble, if you want to call it a bubble, is at. But I'm open to this being a possibility. I don't think it's going to be a possibility, but I'm concerned about the potential here of a recession, leading people to treat Nvidia like Cisco did in 2000. So just something I'm cautious of. Not necessarily a prediction here, but want to follow this closely. Again, I think the AI bubble, AI stage is at a different life cycle than where we were in 2000. I think we're just getting started when it comes to building out these data centers. I think there's so much more room to go. So take it for what it's worth. But on the flip side, yes, gold is where it's at today. Everyone is talking about gold. Gold is everyone's favorite hedge today. I remember last year, if you were a follower of this show, you would have known that we were recommending gold last summer, made several trades on it. So yes, we're always, we've been watching gold, following it to the upside. And I think now with all this attention on it, people are saying, hey, now is the time to just jump in and buy gold up another, 3% today, whatever it is, or it's not, but for me, it's just now is not the time to just say, hey, I'm going to buy, I'm going to take it at, GLD 316, 317, whatever the price is. I'm just going to go and pay that price. No, that's not how I would buy gold today after the move that it's had. Let's just take one more look at another gold chart here, if you don't mind. If you want to humor me here. This is the S&P 500 divided by the price of gold. So as you can see, it goes through these little peaks and valleys. Obviously, there was, bear markets, inflationary pressures in the 70s, bear market in 2000 and 2008. So you got the S&P 500 gold rising, people saying, oh, I don't want to own stocks. I want to have my money safe, put it in gold. That's when you see this bottom out. Now, the question is, where is the bottom going to be? I have a hunch that'll be back down here below 1. That said, maybe now we're at the bottom. You can't really predict anything for sure from this chart. Another thing I wanted to look at with this chart here is this consolidation we saw here. Okay, so from the 80s through, the Great Recession, we had a big run up in gold. We had that big inflationary scare of the 70s, and then kind of stalled out here. So we had gold 600 at the peak, long consolidation, and then big rally. right after we broke through. So we just went from 600 to 1800 here. 600 so to 1800. So that was a 300% return on that rally. So we're at 1800 here, got this consolidation here. Where's the target? If we're going to do 3x, if it's going to be the same, now there's no guarantee that it is going to be the same, obviously. But if it does go 3x, then that'll be 5,400. So there's still plenty of room to the upside, potentially. If we get that 5,400, one more thing to point out here. We would be going down further here if we do go to 5,400. The market, of course, bottomed here in 09, yet gold, this ratio still kept going higher for another couple of years. So gold was still a buy, still a better own than the market, even though the market bottomed there. So just an interesting thing to point out. Even if the market does bottom, maybe gold can still go higher. We will be watching that, obviously. So here is my trade in GLD, and currently about currently about 316 in GLD. Looking at buying a March 323.30 call spread, selling the March 300 put. Net cost 20 cents to do that all in. Now, yes, I feel like gold is going higher, obviously. 100% conviction that it's not going to be lower next week. I would just buy gold, of course, but it's so volatile. We saw how quickly it ran up. This is a cheaper way for me to enter it. And if it does have a short-term pullback, which it's way overdue for a short-term pullback, I won't take any losses down to 300. I'll buy it down to 300. Much rather own gold at 300 than at 315. I think that much is obvious. But if it does continue higher, I'm going to participate to the upside on this trade, which I do think it will be going higher for the medium to. I'm not even sure how long until we get to 5,500, 5,400. That would be the spot where I would say, hey, that's enough here for gold. So watching this all out, if you think that's a good trade, let me know. If you don't think if you think it's a terrible trade, hey, that's your opinion. You're welcome to it too. Just kind of a short-term way for me to get into gold, a little less risk. This is going to be protection for the portfolio too. And maybe it could be a win-win, portfolio higher and gold higher. That would be a great thing to have. But yeah, if the dollar continues to fall, money continues to get sucked out of the U.S., it'll go into gold because gold is just like an alternative treasuries right now. People don't want to put money in treasuries right now. They don't want to own any dollars. The only thing left that people say, hey, I feel safe owning is gold. So that's where we're at right now. It's not the best thing for the economy. Much rather see that money in treasuries, much rather see that money being invested in U.S. companies. But that is what it is. We're going to just take it for what it is. And, that's all we can do as traders is just take the market. We can't make the market. We just got to look at the signals, look at what it's telling us. And yes, it seems really overbought right now. I don't want to jump in and just buy it right here at the highs, but I do want to play it for further gains to the upside. So that's how I'm looking at gold. And just general, this market, again, let's remember we're in a bearish path. Okay, we're in a bear market. There's no question about that. The path of least resistance is lower. Something has to change. So we have to get headlines changing out of Washington. We have to change our path here. We have to get a catalyst to stop this decline in the market. I haven't seen that yet. There are lots of opportunities this week for a catalyst. Until that happens, though, we're just adjusting accordingly. And just, it's in bull markets, the saying is to buy the dips. In bear markets, unfortunately, the saying is to sell the rips. So just going to be trading it accordingly until we get a definitive change in the dynamic. Remember, I'm here every week here on Equity Armor Investments. This is the Trading Zone. Remember, if you liked this, if you liked this article here, you can check it out on equityarmoredinvestments.com. It's up there. Subscribe It'll be sent to your email every when it comes out. You can get an RSS feed on it, of course. If you want to get emails with my trade recommendations or my trade ideas, feel free to do so on the website as well. Again, I'm Joe Tigay, and this is the Trading Zone. Have a great week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.